Good morning, everybody. I'm Jeff Bramson with JLL here in Los Angeles. I sell office buildings, so when Richard asked me to participate in this panel, I said, well, I'm a better panelist than moderator. And he said, well, the subject is multifamily. And so that sort of left me out. So I sat on the end in case I need to make a quick getaway. But my therapist thought this would be a good exercise for me to work through, to talk about multifamily debt, because I've always been jealous of it. I've always felt like if we could just get that Freddie Mac, Fannie Mae stuff for office, the whole world would be different. And climate change would be solved, and like all kinds of good things would happen. But we have a great panel here. We have a banker, we have a debt fund, and we have a debt intermediary, so we should get a very full perspective. So I want to start with Anita and talk about sort of where deals are happening currently today in the market, fresh, like who the lenders, where's pricing, kind of give everybody a snapshot for what's happening.
Great. My name's Anita Paryani, and I'm with Newmark, and happy to be here. I will say my parents were opposite of Daryl. I'm Indian, and they took away my suitcase with the hopes that I would never leave the house. But fortunately, I did leave to come to USC, and I'm happy to be here. So I was asked to start on a positive note. So on a positive note here, there is capital. And particularly in the middle market space, we're seeing a good activity, pickup of acquisitions, a lot in the Pacific Northwest. Recently, we had a client tie up a very nice multifamily deal in the East Bay at a 6.25 cap rate. And there's lots of capital chasing that deal. Particularly, obviously, agency's the easy one that you want to do all day long, where we're getting close to 70% leverage on an acquisition. So we're starting to see the bid-ask gap come to some senses now. But in addition to agency, there's banks, credit unions, there's debt funds. So there's there's choices, which is good. The choices are now in the 6% range. It's not in the 3% range, we all know. But we do have choices, and these acquisitions are starting to make sense.
So there is positive leverage.
Yeah, I mean, your cash-on-cash return is probably still low, but the deals make sense.
Sure. Mark?
I'm going to continue the positive tone since we talked about a lot of headwinds this morning. We could all focus on the negatives, but to Anita's point, I think the overriding theme in the debt side is there's liquidity today, and that's a really, really good thing. If you go back to the GFC, you look at what liquidity there was in 08, 09, and 010, there was very, very little liquidity. Private label CMBS for those 3 years, 08, 09, and 010, totaled about $25 billion. Year to date, in 2023, private label CMBS, we've already originated $38 billion. So there's lots of liquidity today from lots of different sources. It's not a liquidity issue. It's just simply elevated interest rates. And as we saw from the earlier panels, it's not so much that rents are falling, they're just moderating, which is not a bad thing either.
And so continue that theme as far as you and your firm are concerned, the relative risk-adjusted returns you can get on multifamily, multi-housing versus office retail. I'm sure you're going to say you don't lend on office because I hear that a lot, but give us a sense for sort of where multi kind of falls in.
Multifamily is still the favorite child, right up there with industrial at the top of the list. We're not looking at any office loans whatsoever. I think most debt funds and other lending institutions are in the same boat. We would rather and have the ability now, because it's less competitive, to actually lend on multifamily. The good news, bad news, for borrowers, the good news is agencies are very active. Their percentage of the market share has almost doubled from last year through this year so far. They have the cheapest spreads in the game. If you're affordable, if you're a mission-driven project, you're going to get great pricing, the best that exists today in the marketplace. But there's, enough for all of us to go around, even the debt funds, that have higher pricing because not everything is mission driven and affordable, and Not everything is shiny, brand new, and so there's lots of availability for pretty much all lenders if they want multifamily exposure.
It all starts with the banks, though, Todd. So
Well,
you brought the truck
it all
with you
starts
today,
in some,
right?
hopefully it doesn't end with the banks. My name's Todd Popovich with HSBC. Thank you for having me and us. It's a pleasure to see you all, a lot of friendly faces out there. And I'll stick with the theme of positive. And I agree with both my peers. There is liquidity. There is liquidity out there. Who's providing the liquidity has radically shifted. There's not a lot of liquidity across the banking landscape, or certainly not what there used to be. That market share has dropped, and that void has been filled to some degree by more activity on the agency side and a lot more activity on the private credit side. And so in the business that I'm in, we have much more appetite to sort of lubricate the system by providing what's called back leverage to the debt funds to leverage their positions, and they then in turn provide the loan directly to the real estate owner or operator. We're very active in that space.
What does that look like? Describe
It
back leverage.
looks good relative from a bank perspective to making a direct real estate first deed of trust secured loan. I got to a point after doing this 28 years, if you can't beat them, join them relative to trying to compete with Mark and other debt funds. Banks can't go to that leverage level, and the leverage level that a bank can go to today candidly doesn't help a lot of people. And so what it might look like is maybe somebody's got a multifamily development coming out of construction, it's newly completed, it's Class A, it's 30% leased, and that developer is facing a construction loan maturity. It's expensive debt, is probably recourse, they need to refinance it. A debt fund, and there's quite a few of them that are active in this space, and investors that are capitalizing them to be active in this space might come in and maybe make a $100 million loan, and that leverage may be at 70%. And that debt fund then may want to make that investment with no leverage, right? Because it might be SOFR is 532, 5.32 today. Their spread might be 400 over, and that's a really nice return, 9 or 10% even with no leverage. Or they maybe come to somebody like me and say, well, can you leverage my position? And I probably can, and it might be at 70%. 70%, and to make the math basic, the debt fund's leveraging somebody 70%, and I'm leveraging them 70%. 7 times 7 is 49, so we call it a look-through. My look-through loan to value in that example, to your question, what does it look like? It looks like literally 49% leverage and NOI divided by the loan amount, debt yield. If the debt funds last all or on a stabilized basis, which might be 2 years from now, is a 7 debt yield, and I'm leveraging 70%, now I'm at a 10 debt yield. So it looks, from a banker's perspective, that's much more attractive, to us at least, in the current environment versus making the direct loan. We still make direct loans, but we're not very competitive in the current environment, candidly. And then the last piece of that, so a lot of capital is flowing here to facilitate this movement. The last piece of that, perhaps, is, well, now that's an interim bridge loan that a debt fund might be making that I might be facilitating, providing some leverage. Well, how does that bridge loan get taken out? As Anita was mentioning, and Mark, right? The agencies, especially if it's mission-driven and has an affordable component, are alive and well, right? So that 2 or 3 year debt fund bridge loan does have an exit that's going to be often, it might be an agency financing. The CLO market, collateralized loan obligations, that market is choppy and it's rough, but it's been off and on this year, and that's also a potential exit to these types of bridge loans. That's a mouthful of stuff. Did you get it?
But I imagine it's more cost effective to provide back leverage because you can put out a lot more dollars with one loan officer versus lots of smaller deals.
It's
with
very,
lots of loan officers.
it is very efficient. Mark and I were talking about this earlier. It's efficient for a couple reasons. One is, for a lot of institutions, it's very possible that the capital treatment in a securitization type structure, a loan-on-loan type structure where the collateral is an assignment of the underlying loan versus a security interest, a first deed of trust on the real estate, hard real estate itself. It's possible that the capital treatment in that construct is much more benign than it would be as a first deed of trust secured lender. If the capital treatment is more efficient, The returns can be higher. Even the returns can be higher even though the risk is lower.
Can I translate that for the crowd? that means
I'm still trying to figure out 49%.
If Todd makes a loan to me, then he has to reserve less capital on his balance sheet, which means the bank makes more money versus him making the first lien loan that's secured. He has to reserve 4 to 5 times the amount of capital. So it's better for banks to make me a loan than it is to make you guys a loan. So it disincentivizes Todd to make whole loans today. And so
there's that, and I wouldn't disagree with you, right? And there is that, and then in the banking community, this is just a general comment now, banks generally, a lot of pressure, as everybody knows. It could be internal pressure relative to what that bank's loan book looks like. The rate of churn and payoffs of CRE loans has slowed, right? So some banks might suffer from a bloated portfolio, too much CRE exposure, or the perception of too much CRE exposure. Some banks might be under regulatory pressure. And so those all speak to capital efficiency, banks in some cases needing or desiring to recycle their capital more efficiently. Note on note is a way to do that. Portfolio sales. There's portfolio sales afoot in banks and others trying to churn that capital and redeploy it in a more efficient manner. Yeah. So lots of headwinds, but also, I mean, the positive part is there is liquidity, and I know firsthand because a lot of those folks in the debt fund side, I'm providing them the back leverage so that they can provide the real estate owners their loans. Right.
You mentioned loan sales. There has been and will continue to be an uptick in loan sales. Most banks that are looking to sell loans, what type of product are they looking to sell? Multifamily. Why are they looking to sell multifamily versus other product types? Because they get the most value for them today. You know, most multifamily loans today are selling for anywhere between low 80s to maybe mid 90s, depending on the coupon. But most of these coupons were made in the 3 to 4%, maybe 5% range. And so you're, just based on where rates are today, those loans are only worth, 90, maybe 85 to 90 cents. But that's a lot better than selling an office loan and, selling it for 40, 50 cents, which is what banks are looking to do. They can't take that hit, but they can sell at 85 to low 90s, and it actually frees up capital to cover that loss on their balance sheet because they're reserving so much capital already for those loans. And so it's actually a positive, and that's why we're going to see more loan sales and multifamily, just because the fundamentals are so strong. That's why banks are choosing to sell those.
Well, you have great insight into the operations of the property too, because the loan's been active for so long, right? So it's probably easier for you to underwrite as well, right? Everybody goes to the sort of the easiest deal that's out there. Anita, I want to come back to you because we're hearing a lot about rate buy downs. We're hearing a lot about remargining loans. Yep. Tell us sort of what you're seeing as far as folks being able to create liquidity where maybe their debt yield constraint doesn't permit them to do so.
Yeah. So for as an example, we just refinanced a construction takeout. They probably built to like a 7.5 yield on cost, and they obviously did not want to put cash in. So what we did was just an agency buy down. So I'm just going to round numbers. So maybe they paid $300,000 in fees, but they got upfront fees, but they got additional $700,000 in loan proceeds. So net $400,000, and then they saved 30 basis points approximately on the rate. So the idea behind that was very limited cash in, and a lot of our clients are doing shorter term. So we did a 5-year loan, and then when you get the lower rate, if you do pay it off earlier, you have a shorter yield maintenance period. A lower yield maintenance because your rate is lower. So that is one way to limit cash in with these rate buy downs. And then you asked about remargining. A lot of the loans we're refinancing right now is they were done 7 years ago, 10 years ago. A lot of them have amortization. So for the most part, a lot of those borrowers have been okay. Maybe a 5% pay down and low balance to be whole with their loan. Obviously, where we're seeing the issues are on the debt fund loans. and able to pay those off. So there's an example, a listing we have in the Pacific Northwest where the original sale price was $25 million in the summer. Obviously, it didn't sell. The loan amount is $19 million. Current offers are coming in now at $17 million. That's a 6.25% cap rate around. So the lender now is kind of taking control of the sale process. The owner's out in this non-recourse loan. And so the debt fund, they need to decide, do I just take back the property or do I take a $2 million loss? So it depends on where people think prices are going. Probably just take the $2 million loss and move on to your next property. But those are mainly the assets that are having the issues, the ones with the debt fund loans. If you put a loan 10 years ago on an agency, you're probably pretty okay. So we'll see a lot of those issues coming up here as these debt funds can no longer kick the can down the road.
It's the debt fund's fault. Mark, how do you respond?
We're here to provide liquidity when no one else is, like Todd. So,
Okay, it's officially become a bloodbath.
Yeah, no, this is great. This is what I wanted. I wanted fighting.
we talked about the wall of maturities earlier today, and I want to go back to that because it builds on what Anita was just talking about. You know, we heard a lot after the GFC about how bad the wall of maturities was going to be in, 15, 16, and 17 because of all these 10-year CMBS loans that were done in 05, 06, and 07. It was a non-event. We had lots of charts, every conference, we talked about it. For multifamily, I think it's going to be a non-event as well. We can put the number of loans and the volume up on a chart, and it looks real high. But to Anita's point, you need to break down those loans. How many of those loans were 10-year loans that are coming due? Those are perfectly fine. Even 5-year loans where rents have, increased 50% and values have doubled, those loans are fine as well. You have agency loans that maybe have amortization. Those loans are fine as well. What loans are in trouble? That small percentage of debt fund loans that were made to syndicators over the last couple of years on B and C properties with heavy value add, where that business plan doesn't work anymore and they're at 80% leverage to begin with, and now those loans are underwater. Yes, will there be pockets of those situations in distress? Absolutely. But is it a very small percentage? In my mind, it will be. And even in those situations, debt funds, such as ourselves, would rather take back a multifamily asset any day of the week versus taking back an office project in this environment.
Yeah. And so how are you dealing with those maturities specifically? We would like PIN numbers and borrower information. We want to know it all.
Well, I think there are some debt funds that really focused on multifamily. For us, the spreads, quite frankly, were too tight for us in multifamily, and so we were lending on other product types. We couldn't get our yields because of the competitive nature, even from other debt funds on multifamily. Today, the spreads obviously have widened, and the base rate, with SOFR being up at 5.3%, we can make our return targets, and there's a little bit less competition. For us, it's size. There was always a portfolio premium for the last 5-7 years. The bigger the deal, whether that was an asset sale or a debt financing, you generally got better pricing, you got better debt terms, or you had to pay more, or if you're a seller, you got better pricing on your assets when you went to market if you took bigger assets to market or you took portfolio. Now we're in the opposite scenario where it's a portfolio premium. If you're over $100 million, you're going to be paying more likely for your debt because it's less people that are willing to make that loan. We like to play in that space so we can get a little bit more because of size. Same if you're selling an asset today, you really don't want to take assets, above $100 million. It's just the limited pool, Kitty was talking about the 100 potential investors. You go above 100 million, it shrinks even more that's looking at those types of assets. I think, Anita, you made the comment the other day, smaller assets are more liquid and they're getting better pricing and they're getting better debt terms as well. And we're just in that environment today.
Yeah.
Yep.
Todd, so One of the things people are underwriting, obviously environmental risk, as we just heard, political risk, as Daryl so articulately talked about, right? I feel like banks have political risk as well because you're a regulated entity. So, tell us everything you know about the FDIC and how they're going to destroy your life.
That sounds like a fun one.
Yeah. You
On to
could
the
tell I had
negative
therapy
now.
this morning, right?
I would. My observation of the regulatory environment is people's hearts being in the right place, trying to contribute to solutions in an otherwise difficult environment. That said, I mean, there is, for many banks, lots of regulatory scrutiny and pressure. And I would say, bouncing off of what Mark and Anita were both saying, that there's an algebraic, I'm a Ukrainian guy with glasses, I'm really dorky, and I know this, and my wife reminds me of this, so let me be dorky for a second. Let me be me for just 1 second. There's an algebraic ratio, right? At cap rate to stabilized debt yield is leverage. So let's just think about that for a second. I'm going to come back to the regulatory environment on that. So if there's a stabilized 7 debt yield that Mark was talking about on a multifamily, we know from our own discussions and from the prior panelists, and Richard was commenting, cap rates aren't 7, right? They might not even be 6, right? So if cap rates are less than 7, the leverage on that multifamily asset is below 100%. So it's not a problem in the sense of somebody going to be losing money, like the bank or the debt fund is not going to be losing money. It is a problem relative to how does that loan get refinanced, because there's a refinancing deficit. There's a mortgageability shortfall. So when that owner who's got the 7 debt yield money coming due talks to Anita and says, help me get this loan taken out, she's going to say, I'm happy to help you, but it's going to be a cash-in refinance. So I'm going to use that math as an example, now coming back to reality. So is that a stressed loan? It's yes and no. It's not stressed in terms of, wow, the lender is going to lose money. Definitely not. Is it a stressed loan from a regulatory perspective? Maybe, right? Because there's an ambiguous exit. It needs to be right-sized. Capital needs to come in order for it to get refinanced. So if you take that as kind of a micro, kind of nerdy example, because I'm a nerd and I can do that, that's a scenario where there's some pressure for banks, pressure to downgrade. What happens at a bank when you downgrade? The reserves go up. Then we're back to the beginning, the preamble. Well, the cost of capital, the reserves are going up. That's now inefficient capital. It's sunk into that deal. Now, what Mark was saying earlier, that bank may say, hey, maybe I'm better off. Perhaps I should sell this note, even though it's performing. So all of these pressure points are involved in this equation. But I do agree with Mark and Anita and some of the prior panelists. So as to multifamily, is that 7 debt yield a problem? Not in this grand scale of losing money kind of problem. Does that mean, I want to be empathetic to many of my borrowers, does that mean it's not painful if you're the owner to come up with the capital needed to get that 7 debt yield to a 9 debt yield so that you can go get an exit loan? That's super painful. Easy for me to say because I'm not the guy that has to right-size the loan.
Right. And so how are you managing borrowers who are coming to the bank today saying, I'm in trouble? What happens?
It's all a negotiation, and in the business that I'm in, everything is on balance sheet, meaning it typically it's our money. It's not been offloaded or in most instances, and so it becomes a negotiation. Well, what can we do? Pay it down a little bit. Maybe we can't get it paid down as much as we would want at the bank. Maybe it has to be paid down more than the owner wanted to pay it down. A combination of some pay downs, kicking the can down the road in exchange for more term. If the loan is non-recourse, the idea of a repayment guarantee may be introduced. Mark particularly loves that, loves it. So recourse, right, guaranteeing, as we say in the business, kissing the paper. Amortization, some curtailments, those are the kind of knobs that can be turned to gain more time. And then hope with the passage of time, if you look at the forward curve, where does the forward market suggest that the yields are going to go on the 5-year, on the 10-year treasury, where is SOFR going to go? Maybe it starts to come down. right? And then you live to fight another day and get a couple of years of extra term, a little bit of a cash-in refinance, or go to a debt fund. Challenge with the debt funds is back to they tend to be SOFR-based, right? So SOFR is high, still 532 this morning, and a spread of 300 or 400, and you are in the world of negative leverage, right? Because your return in my example is 7, and that loan's going to cost you 10.
And where are you pricing those look-through loans, the back leverage? Where's that price today?
I'm kind of cheap and easy.
We know, that's why you're on the panel.
They're not expensive, right? Because they're not expensive for a number of reasons, not the least of which is that look-through dynamic, that sub 50% leverage, that double-digit stabilized debt yield. The risk profile is more muted. And if for the loan provider, we have the debt fund's equity ahead of us. The debt fund has its underlying borrower's equity ahead of the debt fund.
So you
we
feel
have
it's very
multiple
secure.
tranches of equity. And so all the risk complexion is different. The capital treatment could potentially be more benign. And so they tend to, and this is, you know, you could read this in publications. I'm not breaching any confidentiality rules here, but they tend to price in the mid-2s over SOFR in that bandwidth.
I think just, again, good news. Spreads are back to where they were a couple of years ago. They blew out as the Fed was increasing rates by about 100 points across the board. Most debt funds, you know, today are pricing in the high 2s to high 3s. And it depends on just quality of the asset, quality of the borrower, the sponsor, if they're a syndicator or whatnot. Those blew out about 100 points, maybe 75 in some cases. But now those have come back in, now that rates have stabilized. And that's good for borrowers. So it's not like we're charging more. It's the base that's really causing these high interest rates. But the spreads are about the same. Todd spreads have moved out a little bit. You know, banks were a little bit tighter, but the agency spreads are tight. I mean, you can get low 100s, you know, up to high 100s from the agencies. And if you buy down the rate by paying 2% generally, that's pretty attractive. And then the other way you can get cheaper rates, you just buy a rate cap. And rate caps have dropped like 25% this week, just based on the CPI print that came out on Tuesday. The forward curve is down. And so you can buy an in-the-money cap now, and you can lower your interest rate out of the gate. It costs money, but it's a lot cheaper today than it was on Monday. So I think we're headed in the right direction.
And on that point, speaking with many debt funds and providing this type of leverage that I described to many of them, a lot of their financings to their underlying borrowers require in-the-money rate caps. Might be capping SOFR at 3, 2.5 even, 3.5. And yes, while it's a capital outlay, the good news is, in theory, it's holding everything else constant. Every month, that recipient of the cap is going to be getting a settlement payment. Every month through the duration of that cap at whatever they call it, a notional amount that was capped. So in theory, holding everything else static, much of that outlay will be returned over the life of the cap. In some cases, depending on where rates end up moving, it could end up even really at no net cost, if you look at it that way. Somebody mentioned patience, but you have to be patient to do that. It doesn't make you feel good when you're writing that $2.5 million check, but you'll get a lot of that money back depending on movement of rates and at the then current time, but in the form of monthly installments. But then what does get you is now your loan is, I'm going to say, let's call it synthetically adjusted to now that 7 debt yield is not upside, it's not negative leverage anymore because the cap is in play. Now that might be 1-to-1 or 1.10 or 1.20 debt service coverage. Now we're in, well, okay, we have positive debt service coverage. That feels good. That doesn't feel like a downgrade. Or I'm sure debt funds have their own mechanisms to adjust. That feels pretty good. It doesn't absolve the scenario 2 years later, 3 years later when that cap is up and the loan is facing a maturity. What is the final exit? But I do believe that with rent growth, even though it's muted because of perhaps increasing expense growth offsetting the rent growth to some degree, but there is probably going to be net rent growth over that ensuing couple of year period. Maybe there's some cap rate relief. and it probably has a reasonable outcome. It's certainly not an ideal outcome for anybody, but it is a workable outcome, I think, for multifamily.
Yeah. Anita, do you agree with that? Because I'm thinking about the debt yield is sort of the rent roll today, right? And so how are borrowers looking at the fundamentals going forward? Do they still believe they will have rent growth?
Well, yeah, like Todd said, so like, say this client's buying a deal at 6.25 today, and they believe that's a good cap rate, and they're underwriting some rent growth, and their exit in 3 years is 5.75. They're making some money. And I think that's how a lot of sponsors are looking at deals. So.
I always say if you can't get to the price, lower the exit cap.
There you go. So.
Yeah.
The math is easy. Mark, please.
It's not often that a group like this that's focused on multifamily can look at rent growth and say slowing or flat to slightly positive rent growth is a good thing. And it's a good thing because that means shelter costs, which are a significant percentage of core CPI, is going to be coming down. Shelter's still 6-7% as calculated as part of CPI. We just saw the forecast. I think everyone pretty much agreed, as I do, that we're going to be flat to slightly positive. There's no way shelter is going to continue at 6 to 7%. If you take shelter to 0 today, inflation's like 1.4, 1.5% today. So there's a lot of people that think we've already blown past 2%. It just hasn't shown up in the numbers yet. So when it does, I think, based on what we saw this week, I don't think the question is there another rate hike? I think it's now going to be, when's the first cut? And that's, I think, what the conversation narrative is going to be over the next couple of months. Unless the rent forecast, of course, is wrong, and it's much higher, but I don't think it will be.
Well, and then we have an election year as well, right? And the Fed is not immune to political pressure ever. So like the likelihood of a cut, I think, is very high in the spring because of that. I mean, that's sort of our view, is that there will be political pressure to start cutting rates because the current administration would like to remain the administration going forward. So
primarily, we're going to see the issue with loans that are occurring from 2020, 2021, where SOFR was super low, and obviously your spreads are much higher. But at the same time, it makes sense for the prior years, but at the same time, so much was purchased in that time frame. Will we have to see lenders work on the same case? Because at the same time, obviously, 2020, 21, the rent growth hit, you were able to increase your income, but 22, if you bought after that, you're done. You really can't grow on your rent. You're not going to meet your debt service. What will have to happen? Because lenders aren't going to want these distressed properties. They're not going to be able to even meet an NOI necessarily. What will need to happen for lenders, EPs, LPs, in order to really keep it going, and in order for the shortfalls in distressed properties not to fully go under, in a sense?
I think anyone in this room that owned assets after the GFC that decided to come out of pocket and fund debt service and hold on to those assets will probably tell you it was the best decision they've made in their career. Holding on to multifamily assets, especially with fundamentals like today, I think 5 years from now, you're going to be really happy. There's lots of equity out there. We really touch on equity today. My company, we invest a lot of equity as well. We love multifamily. We own a lot of multifamily. There's a ton of money looking to put out pref equity to fill that gap of what that lender or what Todd may require on a pay down. And I think that's what's going to happen. If the borrowers don't have it, then they're going to try to find it from equity groups like us. There will be situations where there will be foreclosures or there's going to be sales and lenders will take some hits, but it's going to be so diverse. I don't think it's going to be very impactful to the overall market generally.
Perfect, thank you.
Thank you guys for coming today. So question is, what's going to happen if the Fed drops the rate? Are we going to have prices?
We're going to have a big party. Richard's going to pay for it.
Yes.
what do you know?
I don't know anything, but
Okay.
The prices are going to go up again, right? And the affordability is going to kick in. And how are we going to manage that?
We're at a place where everyone's trying to figure this out because interest rates went up 500 basis points in a very short period of time. If the Fed would have followed their playbook from previous rate hikes, they would have done it over a couple of years. And the real estate market would have adjusted. Lenders would have adjusted, values would have adjusted slowly, and everyone would readjust pricing. What happened was it happened so quick. And so now everyone's trying to figure out what's going to happen next. I don't think values are going to rebound quickly just because they start cutting rates. But cash flow will turn positive. And I think that's got to happen first. We got to get back to positive leverage and positive cash flow before people. But I would tell you, there's a lot of equity sitting on the sidelines that would love to buy today. But there's a lot of groups, and multifamily is the most diverse buyer group and owner group out of any of the product types, and now represents the biggest percentage of transactions across all product types. And so you're probably going to see it on multifamily before other sectors really see an improvement. But you're going to see a lot of equity come back in, but you got to get back to positive leverage. I think there's a lot of people, ourselves included, that just don't like taking on negative leverage, and it just doesn't feel right. And when they start cutting, I think people will get more comfortable that we're going to get back to positive in a shorter period of time. We just have had I think a lot of us have been blindsided by the number of hikes. And so we've given up trying to predict where interest rates are going to go. I think we're finally getting comfortable that we're at the top. There likely won't be another increase, and the next move will likely be a decrease. And as long as we get consensus around that as an industry, I think we're going to see more transactions. More transactions will, I think, provide more liquidity on the equity side, and that will bring in more competition, which will then drive prices.
The bank system not wanting to lend directly to the property owner, being more efficient through the debt fund. What would it take to unwind that, or is that a new dynamic that you see existing in the future?
Well, I think it's a great question, and on a general level, right, different banks have different pressure points. Community banks have different pressure points than large global banks and everybody in between. And before everybody gets too mad at their local friendly banker, Mark made a point I want to reiterate. The spreads haven't changed all that much. It's the underlying index, in this case SOFR, before that LIBOR, which has gone up literally 500 basis points. That's been the issue more than widening spreads. What will it take to renew more vigor for the banking community generally and CRE secured lending? I think when there's less pressure, when a bank can underwrite a deal and not have to suffer the anxiety around the negative leverage, right? Sub one-to-one debt service coverage is really tough for any bank to underwrite into. If they're in the Army and it's an existing loan, they have it on their books and they're working through it, the complexion is a little different. But in terms of originating, to your point, a new loan, I think what will free it up a little bit is more normalcy. So maybe the SOFR coming down, a little bit less scrutiny, and CRE not being viewed right now by many people as sort of a redheaded stepchild. I think when those things, and I think it'll happen, and maybe it'll happen next year. And there are lenders still active, for sure, in the smaller loan space. I'm gonna define smaller for this context of under 100 million or maybe even under 50 million. Once you get north of those numbers, many banks can't or aren't willing to hold that whole exposure, meaning they're going to try to offload it through syndication. The syndication market is hard to predict right now. So I do think there is liquidity in the bank system now for the smaller loans, much harder the loans that somebody would need to syndicate.
And especially like on the stable deals, there are banks who are lending on a stable multifamily. And what we didn't talk about, but is construction financing. That's a whole nother topic, and that's a bigger mess because of what Todd was saying, the gap on what's your return on cost on building a project and what's your financing cost, and how do you make sense of those numbers? So,
well, on that point, Anita, just very quickly, I know we're short on time, but that is a real conundrum, right? Because if somebody's already in the Army on their land basis, they're in it, right? It is what it is. The costs are what the costs are. So not that long ago, somebody like me, and I do lots of construction lending, say, wow, this is an unlevered gross return on cost of, say, 5.5%. That feels pretty good because my SOFR plus 250 construction loan, when SOFR is 25 basis point, all that works. But now a gross unlevered return on cost, even if it's, I saw one the other day, was 7.5, among the highest I've seen in my 28-year career. But even at a 7.5 gross unlevered return on cost, the cost of the construction debt, as Anita knows probably better than anybody, is SOFR plus 350, right? So it doesn't, the math, it's very hard to get construction financing to pencil, and that touches on your question too. Well, when will construction lending appetite in the bank community come back? It's the same answer. There needs to be a reconciliation. Either the gross unlevered returns on cost need to be higher, so there's not the negative leverage, or that index, SOFR in this case, if it comes down, you can solve it that way too. It all leads to maybe staying alive, living to fight another day. And some clients on the CRE secured side of it do that too, just not as much appetite now. They have to make decisions. I have staff, right? Do I build through it? Do I build something that might be worth what its cost is, or might not even be worth what its cost is, because I want to keep all my employees engaged. I don't want to have to lay people off. I'll build through it. I'll take a couple lumps. I'll keep my team intact for the next cycle. Others are just delaying, in some cases, what might be years, the development with those land holdings, are having to cover the carry of the land until there's a brighter days. But if you figure it out, let me know.
So, Jeff, you may not be a multifamily guy, but you're really good at playing one on TV. Thank you for
They spoke slowly for me. I asked them, tone it down.
Thank you. That was a wonderful moderation. Anita, Todd, Mark, thank you very much for joining us this afternoon.